Bond yields are surging. Will history repeat? Let's have a look. Hello everyone, Florian here and welcome to another episode of Heiser Says. Grab your hashtag not sponsored cheap coffee. Let's check out this article discussing, bond yields and asking or comparing and contrasting it to what's happened in history. So let's have a look before we go through this article. Here, this is the 10-year Treasury bond note in the US, and it's at a 16-year high at 4.79%. So it's going up. 4.8% mark in October, reaching a fresh 16-year high after new evidence of a tight labour market strengthened bets that the Federal Reserve will prolong its hawkish stance. So let's jump out to 25 years. If we can see here, once this loads up, there you go. So 2000, just before the GFC. Funny that. We go further here. There you go. I mean, look at that. Look how much it crashed then. Boom. So let's check out this article. So here are the ways the market history is repeating itself amid panic over surging bond yields. Investors are scouring financial markets for signals that echo previous recessions as the massive bond sell-off has raised fears of a downturn. In recent weeks, stocks, bonds, and housing have all drawn comparisons with earlier episodes in U.S. market history. Stocks are reminding some analysts of the late 80s and 2008, while bond vigilantes are reliving the 1990s. The housing market also looks eerily like the early 1980s. Here is where history is repeating itself. So the stock market, 87 versus 2023. The stock market's resilience has Wall Street glancing back towards the run-up to the market crash in October 19th, 1987, famously dubbed Black Monday. In spite of the blistering rally in bond yields that has triggered a market sell-off, US stocks are still doing relatively well. That recalls the weeks leading up to Black Monday when the Dow dropped 22% in a day, Societe Generale's Albert Edwards said. The equity market's current resilience in the face of rising bond yields reminds me very much of events in 1987, when equity investors' bullishness was eventually squashed, he wrote in a note on Tuesday. Just like in 87, any hint of recession now would surely be a devastating blow to equities. So 2008 versus 2023. Overvalued stocks, bullish posturing, and tightening monetary policy reminded JP Morgan's top quant guru about the 2008 crisis. In the couple of years leading up to the financial crisis, the market had been performing well as bullish investors looked past a housing market beset by subprime mortgages. Despite the strong early summer rally, our framework continues to point to challenging macro fundamentals and headwinds for risky assets. Marko Kalenovic said in a note late last month, history doesn't repeat, but it rhymes with 2008. So bond yield 1990 versus 2023. Market veteran Ed Yardeni declared in a Financial Times op-ed on Tuesday that bond vigilantes are back, after previously warning that they saddled up and could be staging a comeback. He coined the bond vigilantes term in the 1980s, referring to investors selling off treasuries to protest federal deficits. They came back in the 90s for the Great Bond Massacre, when investors dumped treasuries, causing yields to skyrocket. Now markets are having a flashback. The bond vigilantes' heyday was the Clinton years from 93 to 2001, he wrote in the Financial Times. Placating them was front and center on the administration's policy agenda. Now they are back. The housing market, the 80s versus 2023. Mortgage rates, following the spike in bond yields, have also breached multi-decade highs, hovering around 7.5%. Such high levels, along with persistent inflation and pent-up demand from a demographic boom, have combined to make the housing market look eerily similar to 4 decades ago, Bank of America said. Back then, baby boomers were entering their prime home buying years, just as mortgage rates had doubled. Similarly, millennials are increasingly entering the housing market today as they mature, with mortgage rates soaring too. If the past is any guide, it suggests home prices are unlikely to rise from here and could slightly fall, but not as much as they did during the 2008 housing crash, according to the Bank of America. We think the 1980s are a better analogy for today's market than the 2008 housing crash, analysts said in a Thursday note. So there we go, everyone. Let's look at this again. We've got the stock market comparing the 1987 crash to today, and let's jump over and let's have a look at what do we want to look at? We want to look at indicators. We'll look at markets, stock market. Let's see how far we can go back. US 500. Is that going to go back to 87? Wall Street closed sharply higher on Friday. Okay. Come on, load up. Gotta love this modem. I feel like I'm on dial-up, guys. So we've got to go back further than 25 years. We're talking 87, aren't we? Shit. I'm thinking the 80s. Yeah, that's 20 years ago. No, it's not. It's 40 years ago. Oh, shit. Oh, boy. I just had a moment there, guys. Oh, okay. 50 years. I gotta go to the 50-year chart update. Okay. Oh shit. Look at that big move in the 80s, guys. I mean, how much of that is inflation? So there we go. You can see that there. Yeah, that's like shit. That's like a normal day nowadays, isn't it? We look at that scale. I mean, so you got to extrapolate that bit. That's the 87 crash there. October 87, right there. Boom. The 21.76% fall. What do we see in a couple of days? So, okay, I mean there you go. That puts that into perspective. Look at how much higher the market is now. What were we at there? It went down to from 320 down to 251, this index. So it lost a big chunk. So are we going to see that here in Australia? Well, I wonder if let's have a look. That's the US. Let's look at, where's the All Ordinaries? The AU200, it wouldn't go back there. Or we'll see. Is that what the All Ordinaries has changed into? They change all these names. They've changed all these names, haven't they? Wait for it to load up. Okay. No, we can't go. Can we back? Oh. No, we can't go back that far. Is that the only ones they have? Where do we want it? America, Asia. Are we in there? We're Oceania. Are you all? Let's see how far back we go to that one. All data. Okay, so here's how 87. There we go. So this index went from 2,382 down November. Wait, 87. Yeah, December. There we go. Okay, so there's the October move. So this is obviously monthly data, but you can see 42%. Shit. So yeah, there's your black October there, your Black Monday, guys. 40% cut in the share market. You reckon that could happen there? And they're saying housing would be flat as well. So let's jump back to here. Bond yields, housing market, flat. So what do you think, guys? Let's have a bit of a chat, eh? I mean, while we did see big moves in those indexes, we also have to appreciate the fact that, well, years later, it's barely a blip, isn't it? So it depends on your time frame. If you're a long-term investor, if you're thinking, okay, I'm investing for the next 20, 30 years of my life. I just want to have investment just sitting there, ignore it. It's just a way to generate a passive income. If the market goes up and down, whatever, I'm still going to DCA into different investments that I'm buying. But if you're kind of, it depends on your life stage. That's what it is. What you don't want to be doing is making emotionally laden decisions based on predictions from the news or from YouTube or from any of the doomer stuff. Anyway, guys, let me know your take on this one. Thanks for watching. Check out HiserBim or Heiser Does. And if you're a fan and want to support us, you can on YouTube or Patreon, using referral links, buying pocket squares, or calling me if you need an architect. Take care. I'll see you next time. Bye for now.